Hello and welcome. On this final lecture video for Chapter 11, I'm going to talk about contingent liabilities and then also do a few quick check problems related to contingent liabilities. Okay, so when we talk about contingent liability, it's a potential obligation that depends upon a future event, but that future event arose from a past transaction or event. Okay. So a good example would be a pending lawsuit. So something happened and now there's a lawsuit against our company. Okay, so there was a past transaction or event, and then that led to this lawsuit. Now, with the lawsuit, what do we need to do with this contingent liabilities? Let's think about the lawsuit. I think that's a good way to think about it. So it depends upon whether it's probable that we're going to lose a lawsuit, possible that we'll lose the lawsuit, or remote. If it's remote, we don't need to do anything. No disclosure. If it's possible and we can't estimate how much we're going to lose, we need to disclose it in the notes. If it's probable that we're going to lose and we still can't estimate how much we're going to have to pay, we have to disclose it in the notes per the full disclosure principle. If it's probable that we'll lose it, and then we can make a reasonable estimate of how much we're going to lose, how much we'll have to pay, we have to record that liability. Okay, so this figure does a really good job of explaining accounting for contingent liabilities. If that future event that arose from a past transaction or event, if it's probable and we can estimate how much we're going to have to pay, record the liability. Probable and we can't estimate, disclose in the notes. Possible, then we estimate in the notes. Okay. Remote, we don't need to do anything. Okay. So when we look over here, let's look at some reasonably possible contingent liabilities. Would be the idea of that pending lawsuit, and that's what I just went over. Another one would be a debt guarantee. Sometimes a company might guarantee the debt of a key supplier or a key customer. Okay, so they're going to have to disclose that, right, as a contingent liability. But if it's probable that that debtor is going to default, and then with that debt guarantee, if that customer defaults, well, we've guaranteed their debt. That means we have to step in. If we're going to have to pay some of that. If it's probable that that's going to happen, then we're the guarantor. We need to record and report that guarantee in our own financial statements as a liability. So what happens with this debt guarantee is we say to a key supplier, all right, you have this debt. We're going to guarantee the debt. The supplier defaults. Now we are the guarantor. Now we have to pay that liability. And if it's reasonably possible, right, or if it's probable that that's going to happen, and we can estimate how much we're going to have to pay, we have to disclose. We have to put it on the books as a liability. Okay, if it's only possible, then you know what, disclose it. Okay, per that figure on the prior page. We have some other contingencies here, environmental damages and government investigations that could also lead to contingent liabilities. Look at this one. The final thing I wanted to talk about is another ratio of times interest earned. So a company, right, when they issue bonds or have some other liabilities, even short-term notes payable, right, they have interest expense. Okay. They have interest expense, so they have it on short-term notes payable, and they can also have it on long-term liabilities, such as bonds and long-term notes payable. So they have to pay interest expense. That interest expense is going to be considered a fixed cost, and what a fixed cost means is that it doesn't change. It stays the same in total, regardless of the level of activity of the company. So it stays the same. So think rent is an example of a fixed cost. So is interest, okay? It's unlikely to change as a result of any operating activities by the company or sales. So the way we calculate it is we take our earnings before interest and taxes and we divide it by our total interest payable. Okay? It's usually quoted as a ratio and indicates how many times a company times interest earned can cover its interest expense on a pre-tax basis, okay? And that pre-tax is earnings before interest and taxes, EBIT, okay? So when that falls below 2, below 1.5 to 2, it remains that default rate increases, okay? So what that's basically saying, right, is this gets lower, we have less income before interest and taxes to cover our interest expense, and that's riskier, okay? That's riskier. All right, so for example, let's look at this quick check problem right over here, okay? And so it says a company's income before interest expenses, okay? Before interest expense and taxes is 250, and then our interest expense is 100. What is our times ratio? Times interest earned ratio, 250,000 divided by our 100,000, 2.5. Okay, B is the right answer. Let's look at number 66. If the times interest ratio increases, what that means is that we have more income before interest and taxes, more EBIT, earnings before interest and taxes, to cover our interest expense, right? So that means we're less risky. We are less likely to default because we have more income to cover our interest expense. So the right answer is B. And then I'm going to do number 62 for you here because I think it's a little bit confusing. It says right over here, uncertainties such as natural disasters. The right answer is A. They're not contingent liabilities because they haven't occurred yet, right? So that's all this is saying. And again, that's why I did this one. I think this one's a little bit confusing, but they're not contingent liabilities until, we have the situation where it's occurred, and now we, maybe because of some natural disaster, we have to now, which the natural disaster was occurred, so there's a past event. Now maybe there's lawsuits or something like that, that now we have to think about those as contingent liabilities, okay? But future natural disasters, no, they're future events, and so we don't consider that a contingent liability until they have arisen from some past transaction or event, okay? All right, well, thanks so much. That ends our Chapter 11 lecture notes. Take care. Goodbye.